back in July 2021, when we had done a session with you on BQ Edge, you were of the view that the street was underestimating the demand for steel. Let's start with steel. And it coupled with the capacity constraints, it could well help demand blossom into 2022 or FY23 as well. What prompted the change in that thesis?
So there were 2-3 reasons, which really made us take notice. Usually what happens is that whenever, rest of the world is going through a little bit of a cyclical correction, China normally used to come back in a big way to support demand. But this time around, because of their, the zero COVID policy, Chinese demand has been struggling. And also, China is a little bit of a spent force now after, 2-3 decades of strong growth. The urbanization in China has already reached very high levels of 60-65%, which is very close to where developed markets are. So the efficiency of Chinese government's impulse is much lower. And plus, one of their biggest market is property segment, which is going through a lean patch because Chinese government wanted to push out, a lot of exuberance which was there in pricing, etc. And unfortunately, now with this COVID, etc., despite government relaxing, the consumer confidence is not there. So I think 2022 is looking like a very lean, period where consumers are very hesitant to spend, even though they may have money. And if you add to that what is happening in Ukraine, Russia, and the energy crisis that we're seeing globally, and US Fed panicking about inflation and raising interest rates, it was a perfect storm in the cup for demand destruction. And so it was visible in plain sight that demand is going to get destroyed, and that is what is really playing out. I don't see this picture changing in the next few months. Probably 2023 is maybe we can come back, but 2022 is kind of a write-off from a commodity demand perspective.
So was it the high prices that have led to a fall in demand, or do you believe the catalyst is actually a reduction in demand which is leading to lower offtake and thereby a fall in prices?
So Neeraj, as normally happens, that's why these sectors are called cyclical, because demand normally tends to move in a cycle. So when everybody was at home during COVID, everybody wanted a bigger house or wanted to build a office in the house, or suddenly they realized that they needed AC, fridge, or other things into their house, which so the demand for goods was running at around 8% higher than the normal average, whereas services was taking a backseat. So you bought your new laptops, you bought your new phones, you did everything that when you were at work from home. Now people are starting to explore, go out. So services is going to go up, and demand for goods is going to come down. And as you know, that commodities are more linked to goods. So probably demand for commodity cyclically is coming down. And if you add to that high interest rates, meaning we are living in a world where everybody wants to do buy now, pay later, or credit card, or so suddenly you think things are looking more expensive. So that is the second, which is playing out. And third, you don't really want to go and work anymore. A lot of people are comfortable sitting at home. So workforce is also not, returning back in a full way. So all these things, I would say, is people are conserving money, and it will take some time before consumer confidence picks up. You saw what happened overnight in US. Markets were trading at a very good level, and then the consumer confidence report came in, and suddenly we saw it plunge. So these signs are all visible that demand is going to remain low.